Well, joining us with some much needed insight, Greg Melia, who is the president of Melia Advisory Group. Greg, we thank you for Skyping in today. And as you sit there looking mighty impressive in your chair, sitting there from your perspective, what on earth is going on? How do we read the tea leaves in this mixed bag of news, Greg?
Well, I think it's very important that you take a historical viewpoint. You don't want to look at the short-term numbers. It can get very confusing. If you really look at a much longer view of history, say going back to, believe it or not, to the 1900s, we're actually, we're in what's called a secular bear market. This is the fourth one since 1998. And the shortest one was 16 years. The longest was 25, which was the 1929 to 54. And so what we tell our clients and teach our clients is that you have these long periods you have these explosive shorter periods followed by very long periods of just nothing short of just volatility. Everybody likes to talk about how great this market is, but the reality is if you go back to the highs of 2000 and you compare where we are today, the S&P 500 is only up 20%. And I had an interview the other day and we mentioned that, and I told him that, if you take 20%, divide by 14 years, you know what you get? In Oklahoma, we call that not a whole lot. And so you take a look at the real numbers and then you recognize that, wow, we're up 160+% from the crash of 2009. And you look at those numbers and you realize if you're being really optimistic today, maybe we get another 15% increase, maybe. I think you'd be really optimistic. But if you look at the fundamentals of our economy right now, what I call boots on the ground, the real numbers, if you look at the long-term unemployment situation, which has not improved, virtually all the economic numbers that caused the problem in 2008 are still there. So what I tell my clients is this is a lot of hype, and a lot of this has simply come, that 20% came from an unprecedented amount of Fed involvement. So the other concern I have is with that Fed involvement, people are being driven into the market, not because of good economics. Again, you look at our long-term unemployment, you look at what's happening with our workforce, with the demographics of the baby boomers. The baby boomers are retiring at 10,000 a day, and they're pulling out of the workforce. And what's happening is, if you look at demographics, we compare very favorably to Japan right now. And Japan has had interest rates at near zero for many, many years. They had their crash in 2000. And again, their baby boom generation is about 10 years older than ours. So what you see happening is as demographics of baby boomers moving through the economy, in 2007, they hit their peak spending. So now, I speak, most are my clients today, and they tell me every day they're paying off debts, they're paying the cars, they're not buying things, they're looking to get out of debt. So you have the big engine of the economy that's now shut down. And the problem with that is the generation following them just don't have the resources to buy anything. We have a government dependency at an all-time high, more so than we've ever seen in the history of this country. I mean, I've got friends that in 2008 were making $60,000 a year, now making 40 on food, some type of government assistance just to make ends meet. And you see a lot of that going on. So the government, when they tried to do the printing of the money, as we like to say, the quantitative easing, the goal is to reduce those rates so that people will borrow money, therefore spend money, therefore incentivize the economy. That's just not happening if you look at the overall numbers. We're just not seeing that. And so what you have is you have companies, now we're at this, they're not able to improve their top line growth. So what they do is when we get the top of these markets, you see the mergers and acquisitions pick up, you see the stock buybacks pick up, and it's really just an economic trick because the company that starts buying stock, they can't grow their numbers through top line growth. So what they'll do is they start buying their stock back, therefore they reduce the number of shares, therefore they increase their earnings per share, and They look there to try to raise those share prices.
And Greg, let's talk about those mergers because some believe that's why the market is doing what it's doing. Do you see them having a huge impact on what's happening right now?
Well, I think you can easily get caught up in the emotion of it. When you see the fear levels drop these all-time lows like they were what they were in 2007, for me, that's the concern. Again, we're sitting at the top again. And one of the other things that really fits into this well, too, is the fact that in a secular bear market, we typically get 3 or more drops and each drop gets worse. They call it waves of capitulation. We had our first one in 2000 where it dropped by 50%, and then we got all our money back in 2008. It took 2 years the first time to drop, and then in 2008, it took less than a year and it dropped by 60%, a greater percent. So what I'm telling my clients is we've got to be very concerned about a third drop. And if you really weigh what's happening in the market and you look at the actual risk you're taking, especially if you're in retirement, especially if you're right before, I had somebody in my office yesterday. We were talking about this. He's getting ready to retire this year. And here he is, we're up this so much, 160% plus from the bottom of the crash. And you have to ask yourself, if we're really optimistic, maybe we get that 20%, maybe. But what, with all the information we just talked about with long-term unemployment, that we could suffer a third crash that we usually almost all we see in a secondary bear market.
And so, and with a minute and a half remaining, with this third wave coming through here, what do you do with your money? We've got about a minute to answer that. What would you suggest, Greg?
Well, you've got to make a switch. I mean, if you look at the last 14 years, staying in the stock market, you're taking a whole lot of risk for less than a 2% gain, excluding dividends. So if you look for solid income producing assets that are in the 4 to 7% range, and I hear that's not possible, but it actually is, where you have dividend producing assets, if you'd have been there for the last 14 years, you'd be up significantly. Last 14 years, again, if you're only up 20% and you've had, average inflation of 3 to 5%, you've given up a majority of that to inflation, and you've suffered a tremendous amount of volatility for that. And one last thing real quick on that third drop, it will be fast and furious. Again, once it starts, it'll be quick. And if you're in retirement, the question I always like to pose is, if you go to Vegas and you have a chance of losing, maybe gaining as much as 15%, but the loss could be as much as 70%, who would play that card game?
A good point, and where we'll have to end it right now. Greg Melia, we thank you for your perspective on this as economic volatility continues to be the watchword. We look forward to talking to you again real soon here on America's Forum.
Thank you.
Thank you very much, Greg. So a word to the wise, got to be in a saving mode, but then you got to know where to invest. Thanks for investing time with us. We'll ask for some more of it on the other side of this break.